Okay, so we'll start. So, good evening, everyone, and it's a very special event for us at Finvents. We'd like to welcome Mr. Niranjan Avasthi, and it's basically as Radhika ma'am has told us that Bharat Bond is in a way the brainchild of. Mr. Avasthi, and I would not like to take a lot of time. Mr. Avasthi is head of product and marketing at Edelweiss AMC. I would, without taking a lot of time, directly like to give the mic over to Niranjan sir, and let him start about why I also feel Bharat Bond is one of the best ETFs out there. So, sir, the floor is all yours.
Okay, thank you so much and welcome everyone. First of all, thank you all for taking out time this Sunday afternoon / evening, because I know it's been a long weekend and a lot of people would have their own plans. But good to see that you all have come here to listen to us, and shows that how much you all love and are keen to know about Bharat Bond ETF, which has been a very special you can say launch for us. Which completes 1 year today as we speak, actually. So on 26th, the allotment was done, and a very good day to speak to you all about this very special product. So let us start with the basics of bond ETF, and maybe I'll spend some few minutes on explaining how and what are bond ETFs and how they work. Okay, so what are bond ETFs? So bond ETFs are basically a kind of mutual fund which invest in a set of bonds that are part of the bond index. So in an index, there are a set of bonds from various issuers, and bond ETF actually invest in these bonds which are part of the index. Since it is ETF, then it is listed on the exchange. And once it is listed on the exchange, the buyers or the investors can buy and sell it on the exchange. So it's a very simple product construct. What are the types of bond ETFs available? While India is at a very nascent stage at which it is compared to maybe developed countries like US and Europe, but broadly, bond ETFs are, in terms of their types. So there are bond ETFs which invest in government bonds or in replicate index, which have government bonds as an underlying. There are corporate bond ETFs, and lastly, there are PSU bond ETFs also, which invest in bonds which are issued by public sector undertaking. Bond ETFs also come in terms of maturity buckets. So there are short-term bond ETFs, there are medium-term bond ETFs, there are long-term bond ETFs. So just like we have short-term or medium-term or long-term mutual funds, similarly, ETFs also come in various maturity buckets. And lastly, there are bond ETFs which are based on target maturity. The target maturity can be 3 years, 5 years, or 10 years. These bond ETFs are actually similar to fixed maturity plans, which you might have heard of, which are launched by mutual funds. And the advantage of a target maturity ETF over a fixed maturity plan is it is open-ended, so that you can liquidate it anytime. We'll go into much more details of target maturity bond ETF, because Bharat Bond ETF is actually a target maturity ETF in its, if you say what type of ETF it is basically a target maturity bond ETF. Broadly, what are the advantages of bond ETFs? So one is they provide good liquidity because they are traded on the exchange. You can trade it at a real-time basis. They are very transparent because since these are passively managed products, you know where the investments will be done because it tracks a specific index, and whenever you invest, you know the portfolio will be which is there already there in the index, and it cannot invest beyond uh, the index constituent. So it is very transparent. It gives you easy access to invest in bonds, like individual bond. If you want to buy, they can be in multiples of 1 lakh, 5 lakh, and 10 lakh. Whereas in bond ETFs or through bond ETFs, you can easily access these bonds as for as small as 1,000 rupees or 1 unit for that matter. And most importantly, because these are passively managed fund, the costs are very, very low compared to a actively managed mutual fund portfolio. Now let's understand a bit more about target maturity bond ETFs. As I mentioned earlier, target maturity bond ETFs come with specific maturity and they invest in bonds with similar maturity. So if there is a 3-year target maturity bond ETF, it will invest in a 3-year bonds or bonds maturing in 3-year period. It is basically a very unique strategy because since it has a specific maturity, it carries a lesser interest rate risk. Now, let me explain this a bit more. Say, for example, you invest in a bond of 5 years maturity today, and in next 1 or 2 years, interest rates, go up. So generally, what happens when interest rate goes up, the bond price falls. However, because it has a specific maturity, if you hold it till maturity, in all the more cases, in most of the cases, you will earn your return, and these interest rate fluctuation will not impact your overall returns unless you sell it in between when the bond prices fall. And if you sell, there may be a loss. However, if you stay invested till 5 years of this maturity of the bond, more or less you will earn at the yield which you had entered into this bond. So target maturity bond ETFs basically run or follows a similar principle where if it's a 10-year or a 5-year target maturity ETF, you invest today and you stay invested till its maturity, your returns will be closer to the YTM or the portfolio yield at which you have entered. And hence, the most important point over here in this is these products are designed to provide returns comparable to the yield at which you have entered these products. So, for example, again, if you buy a bond at 6% and hold it till maturity, your returns will be closer to 6% unless it is defaulted. So target maturity follows this concept. So what are the benefits of a target maturity bond ETF? One, they are low cost because they come in ETF form. They are transparent. The portfolio is known where it can invest. It is, in most cases, the portfolio is disclosed on a daily basis. It is a well-diversified portfolio, just like a mutual fund. It provides liquidity because it is traded on the exchange. You can buy and sell at real-time quotes. And most importantly, because the structure is such that it will mature at a certain time period, there is certain amount of predictability of returns. So coming to Bharat bond ETF, as I mentioned, it is a target maturity bond ETF. And because of this structure, it brings in the best features of bonds, mutual funds, and ETFs. So let's see each of them separately. If you look at bonds give you predictable returns. As I mentioned, if you enter a bond at 6% and stay till maturity of that bond, you are more likely to earn, say, around 6% returns. They have fixed maturity date. And because of fixed maturity date, there is a lower interest rate risk, or in fact negligible interest rate risk if you hold them till maturity. Now let's look at mutual funds. So mutual funds provide diversified portfolio. They are professionally managed, and most importantly, they are tax efficient because mutual funds in debt mutual funds or even debt ETF, your returns after 3 years, any capital gain after 3 years, you qualify for indexation, because of which your overall taxes on your return comes down. And lastly, ETFs. ETFs are highly liquid because they are traded on the exchange in low cost and transparent. Now, if you look at Bharat Bond ETF, it combines features of all these three instruments: bonds, mutual funds, and ETFs. And how? Let us see that. So first is it invests in public sector company bonds, and it gives you very, very easy and seamless access to these large bonds. If you were to go and buy these bonds individually, the lot size is somewhere around 5 to 10 lakhs. However, through Bharat Bond ETF, you can buy them with as low as 1,000 rupees, which is 1 unit of the ETF. So what is the investment strategy? Bharat Bond ETFs will have a fixed maturity and have a diversified portfolio of all AAA rated public sector bonds. And when I say AAA rated, it is very, very important when it comes to safety of the underlying bonds. It will track the underlying Nifty Bharat Bond Index, and we'll see in subsequent slides how the index is created. But since it's a passively managed fund, it's a ETF, it will mimic, or it will try to replicate the underlying index. It will invest in AAA rated public sector bonds maturing on or before the maturity date of the respective fund. So if the Bharat Bond ETF 2025 is launched, the underlying bonds will mature closer to the maturity date of this ETF, which is around April 2025. And most importantly, it will endeavor to hold these bonds till their maturity with an aim to provide a stable and predictable return. So as I mentioned, if you invest in a bond directly, what you would try to do is you will invest in it today at X percentage yield. And if it is a 10-year maturing bond, you'll try to stay invested for next 10 years, which will give you whatever returns at which you had entered. So this ETF also does follows a similar strategy. It buy these bonds and then try to, or in fact, hold them till their maturity, which gives you a certain amount of predictability in terms of returns. So how it works? Bharat Bond ETF invest in public sector companies which are part of the index. Once the bonds mature, the proceeds are given back to the investors along with the returns which are added over the multiple years. In between, if someone wants to buy or sell these ETFs between the maturity period, they can do so. So it gives you liquidity as well as certain amount of predictability of returns. So while the bonds are invested, or ETF invest in these bonds, any coupon or interest payment which is received by these bonds are reinvested. So if you invest 100 rupees today, the ETF will in turn invest this 100 rupees in the underlying CPSC or PSU bonds. Every year, whatever interest these bonds pay, the ETF reinvests this interest, and at the maturity, say for example, we are talking about 2025 maturing Bharat Bond ETF. On maturity, this entire amount of reinvested interest plus the principal is given back to the investor. In between, if they buy and sell, this interest coupon is already adjusted in the net asset value, and this is how the returns are generated for the investor. Coming to the index, so Bharat Bond is, as I mentioned, it's a passively managed fund, and it replicates the underlying index. All Bharat Bond ETF follow a Nifty Bharat Bond Index. Each Bharat Bond ETF will have a separate index with a specific maturity. So the process of the index creation is, first, all AAA rated bonds issued by public sector companies are selected. Then weights are assigned based on their total outstanding. So higher the outstanding, higher the weightage. Exposure to single issuer is capped at say around 15% max. And then this portfolio is rebalanced at every quarter. So if there is a new issuer, it is added. If the old issuer, goes out because of some reason, it goes out of the index. And this is how the index is, created. And Bharat Bond ETF just replicates this index in a very, very transparent manner. So what are the investment options for you today? As I mentioned, Bharat Bond ETF program started in December 2019 when we launched first two ETF maturing 2023 and 2030. In July this year, we again launched two more series maturing 2025 and 2031. So today you have a suite of almost 4 ETFs available at different maturity buckets. So if you want to invest for a shorter period like 2023, 2025, they are available. If you want to invest for longer period for asset allocation purpose or longer investments, you can go for 2030 or 2031. The YTMs currently of all these ETFs are displayed on the website or a website and even on the slide. You can, whenever you want to invest, you can go to bharatbond.in and look at the YTM, current YTM, which kind of gives you an indication what kind of portfolio yield you may get over the holding period of time. And since this is ETF, of course you will need a demat account. You can invest through your broking account. However, for investors who do not have demat account or do not want to go through a hassle of investing through ETF or putting orders on screen, there is another simple option available, which is the fund of funds option. So we have also parallelly launched Bharat Bond Fund of Funds, which basically invest in the underlying Bharat Bond ETF. So if you look at Bharat Bond Fund of Funds April 2023, its entire investment will be done in a Bharat Bond ETF 2023 ETF. And the yields will be similar because the underlying investments is just in that particular ETF. So for investors who do not have demat accounts or don't want to go through that hassle, they can simply buy the fund of fund option through any of the investment platforms available in India today. So here also we have 4 options from 2023, 25, 30 to 2031. So lastly, why one should invest in Bharat Bond ETF? One is it gives you stability and predictability of return. It is a bond-like structure with fixed maturity, and because of this fixed maturity, it gives you a predictability of return. And if you hold it till maturity, you can be more predictable in terms of what returns you can earn. It provides higher safety because it invests its entire portfolio in bonds issued by public sector. Now, when I say why bonds issued by public sector are safe, it is because they are also known as quasi sovereign, and most of these companies, in fact, all these companies are owned majorly by Government of India, and it is highly unlikely that these companies will default on their interest payment or principal payment. Because Government of India is taking care of them. Also, these within those universe, also the ETF invests only in AAA rated PSU bond issuers, which is again the highest rating in terms of safety of principal. Third, it is very, very transparent. On a daily basis, you can see the portfolio where the ETF is investing. Of course, it cannot invest beyond the index, but within that also, how much exposure is to a particular bond, how the portfolio holdings are changing on a day-to-day basis can be tracked in a very, very transparent manner. You can buy and sell it on exchange anytime during the tenure. So there is no lock-in period. Most importantly, lower tax because it comes under a mutual fund, debt mutual fund taxation. After 3 years, the returns will qualify for indexation benefit. So the indexation benefit actually reduces your tax liability, and even if the yields are similar. So just to give you an example, if Bharat bond ETF is yielding say around 6%, and a similar traditional investment avenue uh, is also yielding similar at 6%, but after 3 years in a traditional investment avenue, you will have to pay tax as per your marginal tax rate. So imagine if you are in a 30% tax bracket, you will pay up almost 30% of 6%, which is 1.8%. Whereas if you invest or if you avail the indexation benefit in a mutual fund structure, which is Bharat Bond ETF, after 3 years, uh, your returns will be indexed for cost of inflation, and assume inflation is 4% during this period. You will just have to pay tax on 2% real gain, which is 6% minus 4% inflation, that is 2%. On 2%, you pay a marginal 20% tax, which which comes out to 0.40%, compared to 1.8%, which was there in a traditional investment avenue. So here, if you see, there is a clear taxation benefit, and post-tax returns are beneficial or more attractive compared to other investment avenues. And most importantly, it comes at a very, very low cost, almost zero cost. The expense ratio is 0.0005%. So whatever returns you get post-tax are almost equal to the YTM at which you would enter. So how do you invest in Bharat Bond ETF? So if you see, there are you can visit bharatbond.in or your broker website and invest in any of these ETFs. The NSE codes and the ISINs are given on the screen. You can also invest through WhatsApp on this number directly. You can download our Bharat Bond app or go to any broker website. Alternatively, if you want to invest in a fund of fund, you can visit any of the mutual fund websites or aggregator websites through which you can invest. You can visit Edelweiss mf.com or bharatbond.in through which you can invest. So broadly, I will, I've covered a few broad details about Bharat Bond ETF. I think so. I'll take pause over here and happy to answer any questions from any of you. Thank you.
Thank you, sir, for that in-depth knowledge of Bharat Bond. I quickly had four questions, sir, that have always been on the top of my mind. Before we move on to audience questions, I would want, if you could enlighten me on them. Like the first one being, sir, what is the difference between liquid Bs and Bharat Bond? Like if someone wants to put money, so why not put money in liquid Bs and rather put in Bharat Bond?
Right. So we need to understand the difference between these two products. Liquid Bs or any liquid ETF is basically a ETF which invests in shorter maturity bonds or money market instruments, or TREPS or CBLO, which is overnight instruments. And the purpose of those ETF is to manage your cash on a day-to-day basis. So if you have 1 or 2 days or 3 days investment, you can just park it over there and again redeem and use it for some other purpose. Bharat Bond ETF is the purpose of this ETF is very different in your portfolio. It is basically for your investments as a part of your debt portfolio and not for day-to-day cash management or surplus investments. So because these ETF or all entire Bharat Bond ETF series invest in medium to long term bonds like 2023 to 25, 30 or 31, this investments you can do if you want to invest for maybe more than 1 year, 2 year, 3 year, or till the specific maturity of the ETF. So today, if I want to invest for 10 years, which product or debt product is available to me? In that case, a Bharat Bond ETF proves useful. If you want to invest for next 2 years, which product I should go? You can go for 2023 Bharat Bond ETF, invest and just stay over there. So the purpose which it solves in the portfolio is very, very different. Liquid ETFs as a category can be used for managing day-to-day surplus liquidity in your portfolio. very tactical. But Bharat bond ETFs or target maturity bond ETFs can be used for long-term investments into debt, which could be more than 1 year, 2 years, 3 years, or even 5 years and 10 years.
Thank you, sir. Excuse me, sir. I had another question. I always wondered if we could, give this as a collateral for trading, and if we could give it as a collateral for trading, what would exactly be the haircut? Is it possible? And if we could give it, what would be the haircut? Because most people are, by nature, they have switched over from investors to traders, especially since March 2020. Now they enter a stock, they exit a stock. There are most of futures and options guys with algos going around. So can we do it? And if we can do it, what will be the haircut?
So just like any other liquid ETFs or something or some other ETF, Bharat bond ETF also qualifies for margin. NSE has clearly defined the haircuts for Bharat bond ETF, and it is similar to liquid ETF at 15%. If I'm not wrong, even for liquid ETFs, it's around 15% haircut. So Bharat bond ETF also qualify for that. The haircut is 15%.
Now, sir, my next question is if the interest in the economy will go lower, because this is not traded at the closing NAV of the day as most mutual funds are traded. This is dependent upon the demand and supply. So what will happen to the prices of Bharat bond, and if the interest rate goes up, what will happen to the Bharat bond prices? And in your professional opinion, do you see the interest rates going up in the next 3 to 5 years, or do you foresee that the interest rates will go down?
So we need to understand the traded price and the NAV, which is the fair value of the ETF. So generally, whatever price at which it is traded on the exchange, it is in sync with the actual net asset value of the ETF. So like any other debt mutual fund, the net asset value of Bharat bond ETF is also calculated at the closing of every day. But at the same time, it is also traded on the exchange till 3:30. So definitely there could be some difference on a day-to-day basis, which we call in technical parlance for ETFs, the traded price can be at a discount or at a premium. So at times, even Bharat bond has been trading at a premium to NAV. At times, due to demand. However, the trajectory or the direction of even the traded price is in sync with the NAV. So over the next, say, 1 year, say for example, the NAV rises by say around 10% because of interest rate movements and all. Even the traded price will move to maybe around 10%. It may not be exactly 10%. It may be 10.1. It may be 9.9, which I said could be premium or a discount. But the direction of the price movement, even on the exchange, is usually in sync with the underlying price. If at all it is not in sync, definitely it opens door for arbitrage trades, because of which at once the arbitrageurs come into the market, the price difference gets closer and closer. So technically, at any given point in time for a liquid ETF which is traded liquid, very liquid, which is very liquid on the exchange, there cannot be too much of a difference between the NAV and the actual price. Your second question on which way the interest rates would go. Of course, we have seen interest rate going down to almost decade lows in last 2-3 months. And given the conundrum of where the economy is going, the lockdowns which are happening, I think so interest rates may stay at a lower level for at least next 6 to 12 months. And once economy starts recovering, they may rise from here. Of course, given that India will be a growth hungry country, it will have certain amount of inflation. Interest rates cannot be at current levels, which is very, very low. Because if India wants to grow at 7-8%, inflation will be in the 4 to 5 or 4 to 6% range. And if interest rates are in 4 to 6% range, if inflation is in 6% rate, definitely interest rates will be also in sync of those inflation rates, which means in the medium to long term, interest rate may rise back again, but in for near term, 6 to 12 months, it may stay at lower levels.
Okay, excuse me. So, sir, I have this one final question. After that, we'll move to the audience questions. Now, there are a lot of banks out there. There's IDFC First, there's AU Small Commercial Bank. They are giving, exaggerated returns on FDs. So, if we were to pin up Bharat bond against the returns they were giving against those FDs, how would Bharat bond compare against that particular instrument in terms of the benefits as well as the tax advantages?
Right. So while I cannot directly compare Bharat bond with fixed deposits or something or any particular bank deposits, but as I mentioned, the beauty of a debt mutual fund or a debt ETF or a bond ETF like Bharat bond is it gives you indexation benefit after 3 years. So if you are looking for investments which is beyond 3 years, uh, this indexation benefit actually works in favor of uh, uh, the investor in terms of reducing the overall tax and increasing the overall return. So I gave that example. Let's take example of a 2025 Bharat bond ETF which is yielding around 5.5% and a similar 10-year FD earning say even 6.5%. You should do the calculation if you are in 30% tax bracket. If your post-tax returns, assuming 4% inflation is better, definitely Bharat bond ETF is an option to do. So the math is basically post-tax returns, looking at the post-tax return and not only the nominal returns. So if that works in your favor, then Bharat bond is an option for you. If you are in a lower tax bracket or if you don't pay taxes, definitely then a higher nominal yielding product would be much more favorable. So the answer would change for each individual, in my view.
Definitely, sir. But then they wouldn't be AAA rated, so like I wouldn't comment on them a lot. So,
Yeah, so as I
anyways,
mentioned, I cannot comment specifically on any, banks or their ratings. But yes, as I mentioned, here it is when we talk about PSU bonds, they are quasi sovereign, and definitely when there is a certain amount of safety attached, one may look at safety more than pure nominal return. So again, if you're looking for safety, looking for a better post-tax return, then Bharat bond ETFs is definitely a right product for you.
okay, so I'll hand over the mic to Abhimanyu now. Abhimanyu, please take over. And there are a lot of audience questions that are coming in, so we can directly move on to the audience questions.
Sure.
Okay, perfect. So I'll just directly move on to the questions.
Sure.
And the first question is that is there any specific extra benefits for senior citizens?
No, actually in mutual fund, I mean, you cannot discriminate between investors. So even if you are a young Indian or a senior citizen, everything remains same.
Right. Okay. So the next question is that if you are looking at a taxation and a yield perspective, do you think RBI G-Secs or T-bills will do better as compared to Bharat bond?
So, T-bills or G-Sec generally, earn you a lower yield because they are sovereign, and PSU generally trades at a certain amount of spread. So usually the spread is somewhere between 50 to 75 basis point over similar maturity in G-Secs. So in that sense, I think so Bharat bond ETF would definitely make sense.
Okay. So the next question is that is there any entry or exit loads when you're investing into Bharat bond?
So in ETF, definitely there is no exit load because ETF don't have exit load. You are free to buy it anytime and sell it anytime on the exchange. If you're investing through FOF, for that matter, FOF, we have a small exit load of 1 month, but after 1 month, there is no exit load. And of course, there is no entry load at all in any mutual funds today.
Okay, the next question is that can NRIs invest in Bharat bond ETFs and do they also get indexation benefits?
Yes, NRI also can invest in Bharat bond ETF, and so as per the taxation, if they are investing in a exchange traded debt mutual fund, they do get indexation benefit.
Okay, the next question is that if we are looking at PSU, health of PSU and the balance sheet, do not, I'll just go over this question again, once again. Okay, so the question is that the health of PSU balance sheets is not looking very good. What's your take on that? Moreover, they are not AAA or sovereign bonds as such. So, what do you think the ETFs given by these public sectors will be doing? How well will they be doing in the coming future years?
If the health of PSUs are not good, definitely it will reflect in their credit rating. There are certain PSUs which are not AAA rated, and of course, because their balance sheets are not as strong. As I said, in Bharat bond ETF, we only invest in AAA rated PSUs, and when these PSUs are AAA rated, of course, their balance sheets are strong. They're structurally or strategically important for Government of India. Government of India has been infusing capital in them, or in some cases they also have implicit guarantee from Government of India, and hence they are AAA rated. So I think so, and in fact over the last many years, as far my memory goes, I don't think so any AAA rated PSU has defaulted in Indian history. So that also we need to keep in mind when we are looking at these bonds.
Okay, perfect. So coming to the, you're talking about the Indian government part. So there's a question based on that. So somebody has asked if you're comparing the returns of Bharat bond to a government bond mutual fund of the same tenure, do you think the returns will be better as compared to Bharat bond, or do you think they will be on par?
Of government bond, so as I mentioned, GSEC, let's take example of 2031. Bharat bond 2031 portfolio is yielding somewhere around 6.66%. And today, if you look at the 10-year GSEC, is yielding 6%. So definitely the yield difference is almost 0.66%, which means this much of return will be additional return compared to pure GSEC portfolio. So as I mentioned, PSU bonds, because they are not sovereign but quasi-sovereign, they trade at a certain spread over similar maturing GSEC. So to that extent, returns would be higher.
Okay. So the next question is that how is the liquidity of Bharat bond in the secondary market?
Right. So the liquidity has been encouraging. On an average, these ETFs, the trades are somewhere between 2 to 3 crores for each of these ETFs. Of course, in last couple of months, 2023 ETF trades have dropped down because it doesn't, provide indexation benefit today because it will mature before 3 years. But all other ETF like 2025, 2030, 31 has healthy liquidity because we have market makers appointed which continuously provide two-way quotes. So whether you want to buy it or sell it, I think so enough liquidity is available. Also, if someone wants to, don't go through that hassle, as I mentioned, FOF is also a good route because in fund of fund, you liquidate your units to the AMC, like in any other debt mutual fund. So if you actually don't need the real-time quotes or real-time buying selling experience, you can very well come through a fund of funds route also, which is very simple.
Okay. The next question is what is the least and the maximum allocation to a single bond in Bharat ETF?
In Bharat Bond ETF.
In Bharat Bond ETF.
Right. So as I mentioned, maximum is up to 15% for single issuer. Minimum, I mean, it can be zero also. So there is no minimal threshold. If the bonds are available in the market, which are part of the index, it will invest in those bonds. But maximum exposure will be capped to 15%. Also, we also look at the index weight. So if XYZ issuer in index it is 10%, we try to maintain it around 10% and not go too low and not go too high.
Okay. The next question is that does the sector-based diversification in Bharat Bond ETF little bit skew towards energy sector?
So as far as debt is concerned, PSU bond itself is just one sector because uh, bonds basically they don't you can say move unlike an equity move in separate direction based on their sectoral exposures. So you won't find a energy sector uh, bond yielding XYZ and some other bond yielding ABC just because the sectors are different. It is more to do with the balance sheet health and the overall credit rating. As far as theme or sector is concerned, all these fall in PSU basically. So PSU bonds itself is a segment as far as debt is concerned. Of course, in equity, it does matter because equity price are very sensitive to what is happening in the underlying business. So if it is skewed towards energy sector, in equity it does matter, in debt it doesn't matter. In my view.
Okay. The next question is that in the FOF, are we having any extra charges such as the expense ratio?
Yeah. So the expense ratio in FOF is 5 basis point. So in ETF, if you see, it is 0.0005, whereas in FOF, it is 0.05%. So 5 basis point additional expense is there in FOF.
Okay, I think the next question is that which AMC provides FOF or Bharat Bond ETF? I think that is pretty obvious. Edelweiss is pro.
Yeah. So
And
in
if you can,
this, yeah, in this entire program is separated in two parts. One is ETF, one is FOF. So whenever we launch a ETF, we parallelly launch a FOF. So you'll find Bharat Bond FOF 2023, 25, 2030, and 2031.
okay. So the next question is what happens to the ETF if after the maturity? Can you still hold it after the maturity, or will a new ETF will be launched?
Yeah. So after maturity, the ETF ceases to exist. Uh, just like FMP or any bond, it will just get redeemed, and then it doesn't exist. The money is given back to you. If you want to roll over, of course, there would be different ETFs available. So if you are investing in 2025 and it is maturing, if you want to invest, that proceed to 2030 for next 5 years, you can very well invest in 2030 or 2031 ETF. And hence we are creating a ladder so that any point in time, if one ETF is maturing, you will always have 2, 3 more ETFs where you can roll over or you can transfer these proceeds and reinvest it. But it will not happen automatically. You'll have to do it. And if you don't do anything, the ETF will mature and proceeds will be given back to you.
Okay, the next question is about actually the performance of how Bharat Bond usually performs during global crises, like where massive crashes comes into equity. So, how does Bharat Bond perform during those cases?
So equity and debt are two different asset class. uh, if you see in the recent 6, 7 months when markets fell, yields moved up, and then again RBI came into action. They cut interest rates, and then yields moved down. So till the time debt and equity segments are different, there is not much correlation between the two markets. And because debt ETFs are linked more to what RBI does in terms of whether they are rising interest rates or cutting interest rate, it is more linked to that rather than equity actually.
Correct. It depends on the interest rate futures because
Yes.
of the hedging they do.
Hedging, no. So it is basically dependent on. So if RBI is cutting rates, definitely all bonds, whether it is short, medium, or long-term bonds, the yields will fall. And if yields are falling, the price of Bharat bond ETF will go up. Similarly, if RBI were to increase interest rates, then bonds yield will also increase, and in that case, the prices of Bharat bond ETF may fall. So in debt, basically the correlation is with interest rate is inverse. If interest rates are rising, bond prices will fall. If interest rates are falling, bond prices will go up, which is what we have seen last 1 year. Interest rates have crashed. They have come down from, as far as long-term interest rates are concerned, 2030 Bharat bond ETF, when we launched, it was launched at somewhere around 7.5%. Today it is yielding 6.62%, which means interest rates have fallen in last 1 year, because of which the prices of Bharat bond ETF has gone up beyond their usual interest rates or yield.
Sir, I would like to interrupt Abhimanyu here for a small question. Actually, this has personally happened with me, and for that reason, I wanted to ask, and Bharat also used as portfolio insurance, because what happened in March, Nifty crashed around 37%, if I'm not wrong, but Bharat bond, it only corrected around 2%. This is what I'm talking about, the April 2023 maturity. And I was personally invested in Bharat bond because I am a very, you can say, a scaredy cat type of a person. I'm very prudent. I am very bearish by nature. So it was sort of a stepping stone for most of the decisions I made in my portfolio, because where most of the markets were crashing, most of my portfolio was down only 2%, and Bharat bond comprises most of my portfolio. So do you feel that Bharat bond for a Joe investor, can it be used also as a portfolio insurance?
See, these are two different asset classes. As again, Bharat bond ETF is a debt as far as asset class is concerned, and when we talk about market or Nifty or equity market, definitely these two will have very different correlations. When equity market will crash by maybe 20-30%, debt market will definitely not crash to that extent, because debt markets are very stable. Even if interest rates go up by maybe 50-70 basis point, which they did in the month of March, debt will definitely not fall to the extent of what you see in equity. So in that sense, definitely in terms of asset allocation, it is important to have an instrument or investment like Bharat bond ETF, which will give you some hedge when markets aren't doing well. So, and we say this every time when we talk about asset allocation, that all your eggs cannot be in the same basket, which is equity. It can be into debt also, it can be into gold also. So if you want to diversify, definitely as far as your debt portion is concerned, Bharat bond ETF will prove beneficial and will provide some downside protection when markets are falling. At the same time, let me also tell you that since April till date, markets have also gone up 80%. But Bharat bond is a debt instrument, and it will not go up 80%. It might have given you a better return because interest rates have fallen from there. So if you want uncorrelated assets in your portfolio, definitely Bharat bond ETF will prove beneficial to you.
So it didn't go up that. It doesn't go up as much, but at the same time, it doesn't crashes around 25-30%. So like when Nifty is crashing, you have some sort of an insurance when you have 10% or 15% allocation to Bharat bond. So that is what I was just asking. I got my answer. Thank you. Yeah, Abhimanyu, you can continue.
Okay. The next question is that what is the difference or the benefits basically of having a Bharat bond instead of a banking on a PSU bond?
Yeah. So most important difference, and we also have a banking and PSU debt fund which is doing well. But between a mutual fund and a Bharat bond ETF, the basic difference is Bharat bond ETF has a specific maturity, because of which it acts like a bond in your portfolio and you have a certain amount of predictability. So if you were to invest, say maybe for 5 years today, and if you select Bharat bond 2025, the current YTM is around 5.46%. And if not certain, at least you can be, you'll have some predictability that next 5 years, okay, my return, if I stay invested till 2025 or the maturity of this ETF, Bharat bond ETF, the returns will be closer to this YTM. Whereas if you're investing in an open-ended debt product, and it can be any product, maybe a corporate bond ETF, a corporate bond mutual fund, or a banking and PSU mutual fund, or any other debt fund, your returns will not be predictable. If current yield of these funds is maybe around 4.5%, the returns can be 6% also, it can be 3% also, because the returns are to some extent also dependent on what or where the interest rate will go over the next 5 years. So if interest rate keeps going up, the returns of banking and PSU debt fund could be very different. If they remain stable where it is, the returns could be closer to their YTM. But in Bharat bond ETF, if you invest, whichever way the interest rate goes, whether it goes down further, it goes up again, your returns will be in that band of the YTM at which you have entered. So structurally, these two products are very, very different.
Okay. So coming to the, like you were talking about the rise and fall of interest rates. So there's a question based on that. So suppose the interest rate is, or like it remains constant. Now, because it being traded on the exchange, can the underlying value of the asset change a lot due to the demand and supply?
Yeah, good question. See, how ETF works is, one is the ETF portfolio, and other is the traded price, which is it is trading on the exchange. Now, if you are investing and if you are invested till maturity of this product, you don't the traded price will not have any impact, because at maturity it will mature at the net asset value, which is calculated on a daily basis like any other debt mutual fund. But if you were to sell it in market sometime, maybe if you buy 2025 ETF today at say 100 rupees, and you sell it after say 1 year, where the traded price is say 102 rupees, you earn that 2 rupees, which could be different from what is happening in the underlying portfolio. So sometime back, I explained the relation between the traded price and the NAV. So both the direction will always be same. It will not be very different. It won't happen that the portfolio of Bharat bond ETF is yielding say around 8% in next 1 year, and the traded prices maybe 12% or 13% or 6%. It won't happen that way. It will be in sync with the underlying portfolio. So let me give you another example of equity ETF, right? If there is a Nifty 50 equity ETF and Nifty 50 index gives 10% return in next 1 year, the return from the ETF or the Nifty 50 ETF will also be closer to 10%. It may not be exact 10%, but it may be 9.9 or 10.1 depending on tracking error. Even the traded price. Similarly, if the underlying portfolio of Bharat bond ETF generates a 5% return, the price also will appreciate maybe closer to 5%, 4.95 or 5.05. So it won't be different.
Okay. I think this is the last question. After that, we just see if there are more questions or not. The
Sure.
last question is that in the future coming, if we are looking at long term, say 2030 to 2031, and if India were to witness higher inflation rate, don't you think that bonds which are offering fixed interest rates erode the real returns?
Yes. So again, very important question. So if you are investing for 10 years today, uh, and you expect that interest rates, and so today Bharat Bond 2031 is trading at 6.66%. And if you believe maybe after 1 year, uh, interest rates will go to 8% and will not remain at 6.6%. So in that case, if someone has that view, what they should do is rather than investing in 2031, they should invest in 2023 today. And after a year, when interest rate goes to 8%, they can switch to 2031. So, and that is true for any debt investment. So today, if you were to do a fixed deposit, and today FD is at 6%, and after 2 years, if you feel, or even after 1 year, you feel that after 1 year FD rate will go up to 8%, what will you do? You would straight away go for a 1 year FD today. You will earn that whatever 5.5-6% it is, and once interest rate goes to 8%, again you will go for this FD will mature, and you will go for another 8% FD after 1 year. Similar, so this is in technical parlance called laddering, and hence we have multiple ETFs. So if someone has that view that after 1 year interest rates will go up, then they would rather invest in 2023 now, stay invested for 1 year, and as and when interest rate goes up, they can switch to a higher tenure and lock in their interest rates. However, if someone is so today as we speak, Bharat Bond 2031 is yielding 6.66%. And if someone is just happy with 6.66%, he doesn't want to time where the interest rate will go, he can invest, and over the next 10 years the returns would be closer to that 6.66% or whatever it is. So it depends on individual how he wants to pursue his returns, and whether he want to take that call to invest shorter term today, once interest rate rise, then lock in for a longer period at higher interest rate. So it's a very important decision, and one should look at these aspects as well.
Okay. The last and the final question, I think after that we won't be taking any more questions. The last question is that how fast do the funds get deployed into PSU bond portfolio?
So there are two aspects. Today, if you see, this entire portfolio is already deployed. Almost 99% of the portfolio is deployed in PSU bonds. If someone buys today, that money is again immediately deployed. If someone buys it on exchange, it means someone else is selling. So in that case, the money doesn't come to the portfolio manager. It is just buying and selling between the two participants. So in that case, nothing happens at the portfolio level. But if someone is investing maybe 100 or 200 crores, the ETF size grows, the portfolio is created, and immediately the bonds are bought in the portfolio. So that's how it works.
Okay, perfect. I think with that we have the end to the Q&A session. I don't think there are any more questions.
Okay, so thank you so much for having me, and happy to answer any questions even after this session. You can route it to our team, and happy to answer them. Thank you so much, and have a great festive season, and wish you all a happy new year and a prosperous 2021. Thank you.
Thank you again, Niranjan sir, for joining us, and thank you to all the participants who joined us for this session on a weekend. Basically, now we'll take everybody we'll talk about Finvents a little, and we started our journey as a WhatsApp group around a few months back. Now we now have an active database of around 3,000 people who attend our events. We've successfully done more than 14 events now. This will be our 14th event that we've done. And we've proudly associated with around 20 speakers to do free as well as paid events in 2021. And basically we've also hired a consulting editor, and that consulting editor will be writing case reports for us for companies as well as for sectors. We plan to become a streaming service, full on streaming service, which will be like this only. We'll come up with videos and come up with events for investors and as well as traders. And we are also in development. We are also in plan to develop a AI bot, which will provide automated financial plans to all the investors in some time. I'll quickly take over everybody about our speakers. So these are a look at some of our speakers. We have Mr. Vivek Mashnani, Mr. Arpit Bhargav, we have Mr. Srinivasan, Rishikesh Kale, Pankaj Singhal of Anybody Can Fly. Then we have Mr. Nuresh Mirani, Meet Shah, Lalit Kumar Rathi, and Ishmoit Arora of SOIC. Then we have Mr. Avinash, we have Gurjeev Anand ji, then we have Gagandeep Goyal. Then we have Sanjay, then we have Avik sir, Ankit Kanodia, Abhishek Murarka, Suchi Nahar, Debashri Chatterjee, Ayush Agrawal of SMC, then Kumar Saurabh, then we have Soumya Milani, Neil Bal of Nijan PMS, then we have Ashwini Bajaj sir, and I'll also be taking some of the events. Now, we've also hired a consulting editor, like I said. Her name is Vishaka Kochar, and she is a CA by profession. She's also our interim CFO. She's doing CFA level 3. She's earlier worked with Concept Securities and EY GDS Bangalore and GVS and Company. Now, we have an introductory offer for people who want to subscribe to our paid plans. This is not compulsory for everybody, but for people who want to subscribe to our paid plans, we have an introductory offer. So